Hey there, investors! Are you ready to unlock a powerful strategy for building wealth? It's time to talk about dividend reinvestment. This is where your money starts working harder for you. Imagine your investments growing, not just from stock price increases, but also from the power of compounding dividends. Dividends are like bonus payments from companies to their shareholders. With dividend reinvestment, you automatically reinvest those dividends to buy more shares. It's like a snowball effect. As you accumulate more shares, you earn even more dividends. This cycle continues, potentially leading to significant long-term growth. Whether you're a seasoned investor or just starting, dividend reinvestment can be a game changer. It's a simple yet effective way to supercharge your portfolio and watch your wealth grow over time. Get ready to discover how this powerful strategy can help you achieve your financial goals. This image represents the power of compounding. Just like the snowball, your investments can grow exponentially over time through dividend reinvestment. Let's break down dividend reinvestment, also known as DRIP. It's not as complicated as it sounds. When a company pays dividends, you have two options: take the cash or reinvest it. With DRIP, you choose to reinvest those dividends back into buying more shares of the same company. Think of it like this: you're using your dividends to buy little pieces of ownership in the company. Over time, these little pieces can really add up. The beauty of DRIP is that it happens automatically. You don't have to lift a finger. This image illustrates how dividend reinvestment focuses on growing your wealth through dividends. Now let's talk about the magic of compounding. This is where dividend reinvestment really shines. Compounding is the process of earning returns on your initial investment plus all the accumulated earnings from previous periods. When you reinvest dividends, you're essentially compounding your returns. You're earning dividends on your original shares and on the additional shares purchased with reinvested dividends. It's a powerful cycle that can significantly amplify your returns over the long haul. Remember, time is your best friend when it comes to compounding. The earlier you start reinvesting dividends, the more time your money has to grow exponentially. This graph visually represents how compounding can accelerate your investment growth over time. Let's look at a real-world example to see how dividend reinvestment can play out. Imagine you invest $10,000 in a company that pays a 4% annual dividend. In the first year, you receive $400 in dividends. With dividend reinvestment, you automatically buy more shares with that $400. Now, you have more shares earning dividends. In the second year, you receive even more in dividends, which you reinvest to buy even more shares. This cycle continues year after year. Over time, your initial $10,000 investment can grow significantly thanks to the power of compounding dividends. This example demonstrates how dividend reinvestment, even with a seemingly modest dividend yield, can lead to substantial growth over the long term. This chart illustrates the potential growth of an investment with consistent dividend reinvestment. Dividend Aristocrats, the royalty of the stock market. Now let's talk about a special group of dividend-paying companies, the S&P 500 Dividend Aristocrats. These are companies that have increased their dividend payouts for at least 25 consecutive years. Talk about consistency. Investing in Dividend Aristocrats can be a smart move for dividend investors. These companies have a proven track record of weathering economic storms and rewarding their shareholders with increasing dividends. They are often considered to be reliable and stable investments. Remember, past performance is not indicative of future results. However, the historical performance of Dividend Aristocrats highlights the potential of investing in companies with a strong commitment to dividend growth. This image showcases the logos of established and reliable companies known for their consistent dividend payouts. Getting started with dividend reinvestment step by step. Ready to get started with dividend reinvestment? It's easier than you think. Step 1. You need to choose a brokerage account that offers DRIP services. Many online brokerages offer this feature. Step 2. You need to select dividend-paying stocks to invest in. Look for companies with a history of paying dividends and a solid track record of earnings growth. Step 3. Once you've chosen your stocks, enroll in the DRIP program through your brokerage account. It's usually a simple online process, and that's it. Your dividends will be automatically reinvested, and you can sit back and watch your investments grow. This image shows how easily accessible dividend reinvestment plans are through online brokerages. Choosing the right investments. Finding dividend stocks that fit your goals. Not all dividend stocks are created equal. It's important to choose investments that align with your overall investment goals and risk tolerance. Consider factors such as the company's dividend history, financial health, and growth prospects. Don't chase high dividend yields blindly. Sometimes a high yield can be a red flag, indicating that the company's dividend may not be sustainable. Diversify your portfolio. Don't put all your eggs in one basket. Spread your investments across different sectors and industries to reduce risk. Remember, investing in individual stocks requires research and due diligence. If you're not comfortable picking individual stocks, consider investing in dividend-focused mutual funds or ETFs. This image emphasizes the importance of research and due diligence when selecting dividend stocks for your portfolio. The tax man cometh. Understanding the tax implications of dividends. It's important to be aware of the tax implications of dividend income. Dividends are generally taxed as ordinary income, but qualified dividends may be eligible for lower tax rates. Consult with a tax professional to understand how dividend income will affect your tax liability. Keep in mind that even though you're reinvesting your dividends and not receiving them in cash, you'll still owe taxes on that income. It's essential to factor in the potential tax consequences when evaluating the overall returns of your dividend reinvestment strategy. This image serves as a reminder to consider the tax implications associated with dividend income. Patience pays off. The key to long-term success with dividend reinvestment. Finally, remember that dividend reinvestment is a long-term investment strategy. It's not a get-rich-quick scheme. Be patient and let the power of compounding work its magic over time. Don't panic and sell your investments when the market experiences volatility. Stay focused on your long-term goals. By consistently reinvesting your dividends and staying the course, you can potentially build a substantial portfolio over time. Remember, the key to success with dividend reinvestment is patience, discipline, and a long-term perspective. This image depicts the potential long-term rewards of patient and disciplined investing. If you found this video helpful, please like, comment, and subscribe for more tips on growing your wealth. Thank you for watching.